All right, let's get started on this webinar. The four golden rules of reading order flow. As someone who has been in a prop firm, I come from the trading floor before computers in the 1990s, got a job at a prop firm in April of 2000. And so a lot of what I understood and took for granted because I was always in the venue of professional traders, whether it was, the venue of professional trading was a trading floor. Then it's a prop firm, and most people don't understand what a prop firm is. Some people get down rabbit holes that it's these funding companies, and there's some value to those funding companies, but that's not a true prop firm. True prop firm was they invested in you. It's a 50-50 profit split for 3 years, at least our contracts were, and then like 75-25 after that. But if you lost money, they lost money. Like if you out of the gate didn't make any money, they had a leash on you, but they didn't make money unless you made money. So there was an investment that they had in you that was a real prop firm. Now, more of them popped up around Chicago because Chicago is the futures kind of capital with the CME and the Board of Trade. The CME now has pretty much gobbled up all of them. And so this is a lot of stuff that maybe you guys have heard this, and that's fine. But if you haven't, it's really important. I often say the basic stuff in trading is also the advanced, and it's because most people skip over the basics. Now, you don't know what you don't know. So I feel for some people that when they get into trading, you get all these blinking lights of what's the best tool and what's going to work, and so you get pulled in all different directions. The internet's great because of all the information at your fingertips, and then it sucks because of all the information at your fingertips. So a lot of times people might be great at marketing because their product is inferior. So don't ever take my word for it or anyone's word for it. But when you're watching this, if it makes sense and clicks, continue to watch, and you'll see what we're talking about. But it makes, and again, if you're just coming in, you're asking questions, I will get to them, but at the end. I'm not ignoring your question. So it's really important to again have it click for you. It's one thing to learn something, it's another thing to understand something. And then I'm going to show some charts that kind of tie this together. I often show this image of my family. I'm the youngest of 8 kids. That's me on the left, my father on the right. Why am I showing this? He told all of us growing up, if you know how, you'll have a job. If you know why, you'll be the boss. So the why is important. And we're going to go through this pretty quickly and then get to these charts. Why price moves. Most people, as basic as it is, don't understand it or explain it. We're going to talk about movement, reading order flow through other people's positions. What is longs? What does that equal? What does shorts equal? All right. Why price goes up and down. And how could you use this today or now? What are the tools that read some of the order flow from a dome or from a footprint chart? And and I think that's why you guys will find this interesting. Longs equals sellers. Some indisputable stuff here. If you're just think about this for a second. If you're long, you open up a long position. What do you have to do to cover or get out of that long position? You have to sell, right? You are a seller after you're long. Longs now equal sellers. Forget about what they were to get long. After you're long, you're a seller. Most of you guys in here probably put in OCOs. You're long, you got a sell order that goes above for a target and a sell stop below. Both are sell orders. The opposite is true. Shorts now are buyers. Remember, this is for after you open the position. You have to put in a buy order to cover a short position. And most everybody that's going to be in here or trades and day trades futures, you're covering your positions. So not only are you a buyer if you're short, but you have to buy it. You're not going to stay short for multiple days, day traders, right? No, you might be short for 5 minutes, for 5 seconds, for 5 hours. You're still relatively a short time frame trader. So after you're long, you're a seller. After you're short, you're a buyer. Back of your hand stuff. What makes the price go up? Keep it simple. When I've asked this question to people, they think the answer is more complex. Simple, more buyers and less sellers. Don't get confused with this. What makes price go up? More buyers, less sellers. And then what makes price go down? More sellers and less buyers. Now, here's what's important. How do you get there? What are we trying to do as traders? We're trying to predict where the hell price is going to go, up or down. So if we answer the question, it takes more buyers and less sellers for the price of anything to go up, and we're trying to predict price, How do we predict more buyers and sellers? How do we do that? And I'm going to bring in a chart. I got to stop the screen share right now. I'm going to bring in a chart, and we're going to build on this chart to show you and discuss the tools that are on it. All right. We're already showing it. Let me pull this up. All right. One other thing, just give me a yes, you could see illustrations. Everybody see that yellow X? Thank you, Jeff. All right, we're good. So what are you seeing here? If I showed you this chart with all the information on it, how do I get this chat? There we go. If I showed you this chart at the end and how it's going to get with the tools added to it, there'd be no question that you'd be overwhelmed. I would be overwhelmed. If I look at a chart and it's got 4 or 5 things on it, I've been in this business a quarter century. I get overwhelmed. I don't know what they are. So I'm just showing you a simple chart of a footprint. Footprints have been around a long time. And what you look at, any chart you look at of mine or yours, understand that no matter the periodicity, what you're trying to conclude is this, the rotational value of what a chart is showing you. If you see this illustration, just the up and down rotations. Now, this is a footprint. And in the past, footprint was great when it came out because it showed you more than just candlesticks and bars. The problem is there's a lot of numbers that are absolutely irrelevant on this chart. You don't have to analyze all these numbers. There's always a better way to see the same thing. Also, a dome. What does a dome have? Lots of numbers. Some are important, most aren't. So it's really difficult to help traders understand how to read a dome and how to read order flow through a footprint when there's a certain feel to it, as well as an objective skill set. What you need to know is, how are you going to put yourself in a position to predict when more buyers and less sellers could come in? All right. And we're going to build on that by starting with, instead of the buy and sell orders that already came in, how to predict the ones that are going to come in that have not been filled. There's a difference between buyers who have been filled and those who are not filled. When you get filled with your buy order, someone shook your hand. When you want to get filled with a buy order and you don't have your hand shook, you still are a buyer. And all of a sudden, if you get that imbalance of more buyers and less sellers, therein lies the probability that the price of that product is going to go up because it's meeting the requirement you need, more buyers, less sellers. You want to talk about imbalances, and we're going to get to that in a second, but you want to talk about imbalances of buyers to sellers, and we're going to start with imbalances of positions in what we call the OPP, other people's positions. And we're going to pop that on the chart and start to build out on this chart. So we're not overwhelming people with all this info at first. Let me walk through what these are showing us. First of all, you don't have to be an expert what I'm going to say next, but the CME about 5 years ago put out what's called MBO, market by order. It's just raw data of every order that gets put in is a sign and order ID and a description of what the heck the order is. Is it a buy market order? Is it filled? Is it a buy limit? And so on. When did it get filled? Is it filled? Partial, size, all that stuff. And the CME's been putting this out for 5+ years. All right. Well, a guy in my room and I became really close friends, with me a long time. And he started filtering this stuff, talking about it. And we just had a simple conversation. I said, well, if it shows you this, then how about that? And that's just the progression of the conversation back and forth that led to these features, we call them on this chart. OPP is other people's positions. If you know longs are now sellers and shorts are now buyers, like we talked about at the very beginning, would it not be helpful if you knew a sample size of longs and shorts in the market? And that's what this shows us. This first vertical right there is over the last 2 minutes. How many contracts have opened up long and how many contracts are opened up short? That's the raw number there at the bottom. If there are more longs than shorts, which there are right now, 33-5, it's going to show up in what I call the laser. It's going to be green. Green for more longs than shorts. The longer this bar, the more longs than shorts there are. And it's a rolling 2 minutes. It also, let me clear these illustrations. This is going to show up right there as well. So there are two places that the laser shows up. So you could keep an eye on when it turns red and starts heading up. When it goes back green, it could head back down. Where it turns green and market starts to sell off. Remember what I said at the beginning. If you agree that after you're long, you are now a seller. We agree with that, correct? If there are more longs than shorts, many, many more longs than shorts, isn't it fair to say that there's more sellers coming to the market? So what we've been able to do filtering this MBO data is understand when a buy order was used to open up a long position. We're not claiming we know all these positions or all the open positions, but a large enough sample size, the way orders are inserted, to make this calculation and follow them. Not only do we know where they're long from, the green bar, but the white line that sticks out horizontally is where they're trying to cover. So a long is going to try to cover above the market, right? For a profit. Shorts are red. All these white lines coming out are exit orders. Buy orders if they're short, sell orders if they're long. So are we all on the same page? More longs equal more sellers. More shorts would equal what? More buyers potentially coming in, because we got to take it from the top. If shorts equal buyers to cover, which they do, then more shorts would equal more buyers. The laser is showing you that delta or difference. Do you see how long it is green? These numbers, a big long came in right there to pop that number. Now, after we tag particular order being long, if it times out 2 minutes, but he's still open, he'll go over to this vertical, which is a 60-minute. So this is giving us an hourly look at how many longs, how many shorts, and where from. And then there's a laser attached to it, which is right here. And here's the raw numbers right there. This laser is just showing you the 2 minute. Now, if I were to say to you, if you are long, do you want a lot of longs with you? A lot of novice would be like, yeah. And the opposite's true. If you're long and there are a lot of people long with you, that's just competition. And it's competition because if you're clear that after you're long, you're a seller, and you're long with a lot of other people, and there's a lot of sellers above the market. Does price go up easier if there's a lot of sellers? Hell no. That's why it doesn't go up. When people say like, well, it'd be helpful to have more sellers and less buyers for price to go down. And I'm like, no, it's not helpful. It's necessary. It's the only reason why price does go down, period. It's the price of a house, a TV, a car, t-shirt, doesn't matter. S&P, crude oil, and individual stock. You see how it goes green to red, and it has a better chance to walk up in real time, not hindsight. Because it's showing you more longs to more shorts. Because you're now reading the market through the eyes of other people's position. Other people's position. Now, here's what's also interesting. Because we know over the last 2 minutes and 60 minutes where people are long from, we're also able, and we added this as we've gone along, we've also been able to then say, well, over the last hour, everybody who's has an open long position we know of, what's the average price they're long from? and we mark it with this dotted green line here. This is what we refer to as a PWAP, position weighted average price. Many people here are familiar with VWAPs. That's just a volume weighted average price. PWAP is other people's positions weighted average price. This is what I said earlier. Don't take my word for it. Watch this in real time. Watch it in some videos that you see on my YouTube channel and everything else on how well these lines react as real-time support and resistance. Now, if the average price over the last 60 minutes that people are long from is up here and price has been down here and price starts walking up to where the market is average long from, and you know they've taken a lot of heat because it's been below it, what do you do when you're long? Let's say from here, you took all this pain and heat and price is about to let you off the hook, potentially to cover that losing long position where you felt all this pain, and now it's maybe going to let you get out for a break even. Remember, you're long and you're now a seller. I guarantee you most of you, because I know I would be begging to sell it and break even. You realize all the pain that you took. It's giving you a chance to break even, scratch. Like, God, I'll never take this much heat again. Get out sooner, all this other stuff. So if that's the way you would feel, and it would be the way you feel, and you're a seller, and you're anxious, and you have to sell it, wouldn't it make sense that this would be good resistance? Have that make sense to you. Have that make sense to you. So the red dotted line is just the average price of where shorts are short from. Now we stagger it out. There's a long here. He's getting out right there. There's a long right there. And so you add up all these, take the amount of contracts and everything else, and we plot the average price. So that's where the market's long from over the last hour. These aren't accurate assumptions either of open, long, and short positions. They're not all the open, long, and short positions, because that would make it much easier to trade. You could put the mouse on the floor and trade with your toes. But this is a big enough sample size because the CME puts MBO data out. Now, I don't want people to think, oh, the CME tells you where people are long and short. Absolutely not. We've been able to pull out and understand the order IDs with my experience being in this business for 25 years from the floor in a prop firm. And then Dave, his ability to build this and understand data and build it out, and then his understanding of markets. So it's that overlap, being able to filter. Now that's OPP. Got it? Got questions? I'll circle back to it at the end. But that's where these two verticals, this is again 2-minute long and short. There's the raw numbers, 60-minute raw numbers. This is the laser. This green is also just duplicated over there. And it's comparing shorts and longs together. And these red and green dotted lines are the average prices the market's long and short from. One last thing before I go on to the next feature. You're not going to find value to anything in life unless you could compare it to something else. Appraisers for homes use other homes. All right? We wouldn't know who's good looking if there weren't ugly people. So you got to compare one thing to another to find value. In this case, we're comparing buyers and sellers, but we're always comparing something to something else. Buyers and sellers, and in this case, longs to shorts. Because if you got a lot of longs in the market, but you also got a lot of shorts in the market, then that means something different. So it's the imbalance that matters. And also remember this about price. Price moves from imbalance to balance. So it needs to find, you know what this is called when markets trade? Price discovery. That's what the markets are doing, trying to discover value. So they move away from imbalance to balance. And when they find balance, they move sideways. It takes imbalance for them to leave. They're not going to remain imbalanced anywhere. They can't. Imbalance means more shorts than longs, therefore more buyers than sellers. By its very definition, it's going to move. but it's seeking balance. And then it does this, just trades sideways. All right, let's move on to the next feature. Puke, which was the original name of the software. And you're going to see it pop in a little bit right in here. There's one example of it. You might came in subtle. What does puke mean? Back in my trading floor days, puke was the slang word for exiting a losing trade with a couple swear words around it. Like I was long from 95 even. I puked them at 93 and a couple more at 92. That means that's where you took your loss. Whether it was a sell stop to cover that loss or whether you just sold that position out for a loser. So puke is a slang word for exiting a losing position. What we found out, and this was actually the first kind of iteration of me talking to Dave and say, wait, if you know this, we probably could find out that. And so we were able to say, when a buy stop goes in, and by the way, the CME doesn't say, hey, these are buy stops and these are sell stops. They don't tell you that information. What we were able to do, however, is knowing that a buy stop is what? What does a buy stop go in as once it's triggered? It goes in as a buy market order. All right. A buy market order is what it looks like when it's elected. Now, this is again in dispute. Really, nobody would argue about this. Most people who use stops use them to cover a position. I know you could open a position with it, but most people use a stop to cover a position, and most of the time a losing position. Just think of your own trading. If you're short, you're using buy stops to cover that position, generally for a loser, correct? So we were able to find out when a buy market order originated as a buy stop. And then knowing that buy stops are used to cover losing positions, and it's short positions, by the way, buy stops are used to cover losing short positions. We were able to throw in little mini profiles, shoot the market, little mini profiles inside the footprint bars that those orders were puking short positions. We also have different charts that we show that highlight this on a vertical and show you where people are puking on the side. But for example's sake, in this webinar, you will see oftentimes, like in a big move out of a congestion box, a bunch of longs puking. So when price goes up, who's puking? Longs or shorts? Shorts, right? They're getting squeezed. So we also show the little profile, and there isn't a lot of them. That's why this profile isn't that visible. But then a number here, which shows how many contracts were part of those buy stops. There's not really many of them. That's why, this is midday. Price isn't really moving a lot. All right. So it was the original. That's why the slang, these charts are called the puke tool. This was the beginning of being able to just have continuing brainstorming sessions, sharing it with the group of how it's being used and how we could continue to filter this really valuable MBO data put out by the CME. All right, the next one. This is fairly new, and they're called imbalanced triangles. And yes, we call them triangles because they look like a triangle or an arrow. Now, there might appear to be too many of them, but not when you understand what they're telling you. And I want to be simple with this explanation. These are showing where people who want to buy or sell it are trying to buy or sell it. These aren't people who bought or sold it. They're people who want to do it. There's more value when you're trying to predict where price is going to go is to track the people who want to do it versus the people who did do it. Because it's the people who want to do it that move price. In a house, if someone's selling a house and 3 people want to buy it, it's easier to predict that the price of that house is going to go up. Why? Did someone buy it? No, but 3 people want to buy it. And there's 3 of them. So we're following and tracking new orders coming in through the order ID. And when plus or minus 3. I don't want to get into the deep specs of it. Just understand the basic concept and premise of it. But around where the last traded price is, or where price is actively trading, which is where people are going to put in orders that are serious. If you put an order 20 or 50 ticks away to get long or short, you're not serious. Houses for sale for 500,000, you bid 300, you're not serious. But if you bid 495, you're going to get a call. Same thing with putting in orders around where the price is, plus or minus 3. And when price starts to just walk away and it's leaving an imbalance of more buyers than sellers, like maybe sell orders are being canceled and buy orders are being popped in, blue triangle. More sellers who want to sell it versus buyers who want to buy it, pink triangle. And the number, the delta, this one's 286 of the difference. There's 286 more contracts that want to buy it than want to sell it, but actively and in real time. And around where price is trading. New orders coming in and new orders being canceled. It's almost like when the market finds what it's looking for, it's got to find buy imbalance in order to go up, right? So it finds it and then it's able to go up. Now we have it filtered for 250 or more, or else we'd have too many triangles. We also are able to change that. So if there's too many, or we deem it to be too many on a particular day, or the way the volatility is that we would adjust that. Because in any tool that you guys look at, you got to have, there's a sweet spot. You have too many, it's just noise. You have too few, we're just not getting the right information. But if you guys know that more buyers and less sellers move the price of anything up, then why the hell wouldn't you want to look for in real time and in spots? Here's another thing that's interesting about this is when the sell imbalance gets breached. Right now it's midday, but you could kind of draw where the buyers are trying to fight, and that's fine. That's the bottom of the range. But if they start breaching and they're not redefending it, that's a good high probability a breakout is imminent to the downside in this case. Plus, you've got a green laser that started up here, which means more longs and shorts in this sequence. All it would take right now is a pink triangle here. Oops, a pink triangle here at the bottom that would be able to push price lower. And there it comes with, the pink didn't come in here, but this was breaching this blue. You didn't get another blue. And see all this purple profile? That is longs puking. That's what it looks like when longs puke, or sell stops. What are sell stops used for? Longs to puke. So you didn't get the pink triangle to push it, but you knew that they breached these blues, they were going to go. And then you do get the pink that kicks it lower. This doesn't have to get you short, but it kept your ass from being stuck long. A great marketer would say, see, guys, look how much money you could have made. BS. I talk about managing risk first, and anybody that you surround yourself with should also. If they're trying to get you big grapefruit eyes and how much money you can make, they're not interested in the success of the tools that they have as much as they should be. It's about risk management. And so the market broke out. It breached. They weren't getting the buy and balance anymore when it snuck down there. And they squeezed out a lot of longs. Many of them puked. When it came back up, bam, quick sell imbalance. And now the sell imbalances are descending and tracing, or chasing. They're descending. As soon as you get the descending triangles to get breached, that'll be the rotation back up to the next target, which would most likely be our red PWAP. But until then, they keep reaching these blues, downside's right side. You see how you're getting sell imbalances are chasing it? As soon as you get it to breach, that's your best chance, if you're short, to cover that short. Now you're using the number one question I've gotten from 10 years of talking to novice traders or people who've been trading for a while and still seek help and everything else is, but where? But where? But where? And that's a good question. Now this is making an objective. See the first breach right here? And what happened? That's your best chance to pop out of the hole. So if you're short and you get out here, do you feel good? Or would you rather let your profits get eaten up and then maybe, oh, come all the way back down and say, oh, see, I could have made more. You don't want to be on that emotional roller coaster. You want to use objectivity. When the sell imbalances finally get filled and breached, that's your best chance to jump out of the hole. Even if this isn't the low forever, it's enough of a temporary low where he keeps you off the damn roller coaster of having a good short trade that's up 8 points, now up 4 points. Because guess what? When you have an 8 point winner that turns into a 4 point winner, it's like you lost 4 points, even though you didn't. You want to stay off that roller coaster as much as possible. If you go back to what the hell you're trying to do in this business, predict price, then you go back to those golden rules that it takes more buyers and less sellers to go up and more sellers and less buyers to go down. And then you understand that after you're long, you're a seller, after you're short, you're a buyer. Predicting and watching the imbalance of other people's positions allow you the ability to see and predict where the hell the more buyers and less sellers dynamic is going to come to fruition. So everything I said in here happens because it's just objective. First triangle they breach, that's probably going to be the bottom. As soon as you got a pink triangle moving through and breaching those blues, was going to be the breakout to the downside. Is it a coincidence that we went from more longs in this laser to more shorts? No, because remember, more shorts equal what? If shorts equal buyers, more shorts equal what? More buyers. Does it help to have more buyers for the price of anything to go up? No, it doesn't help. It's necessary. It does more than help. You see the laser flip also, going from green to red. Objectively allowing you to read the market so the effing thing doesn't seem random or a good guess when you walk through that progression we just walked through together here. And by the way, this is the live market. You guys that are here live see that. All right, next feature called the chaser. The chaser is shown on the far right in a profile of white and green, no, gray, white and gray kind of profiles that are continuing to adjust. It also is shown in a white or gray laser next to the red and green laser. So that white line is either white or gray. And here, by the way, you see now the blues buy imbalances, the market's chasing this up. You're actually physically seeing why price goes up because there's more buy imbalances, but now you're seeing it. And as soon as you could kind of breach, this is a little bit trickier than calling it this one, but as soon as we could breach one of these three triangles, then that'll be the top and that'll be the middle of our PWAPs. So we were going to come back to the red or in the middle because this is the PWAP area of resistance. As soon as you can get a breach, one of these with a pink triangle is the best chance to rotate and kind of come down a little bit. So watch it as we're going through this. The chaser, again, the white and the gray here on the far right, and it's also white or gray on the line right there. It's showing you the difference between aggressive buyers and aggressive sellers. So you know how we talked about buy imbalance, sell imbalance? Well, what if you're able to track people that are bidding and they take their bid from 87 to 88? Wouldn't you say he's aggressive? He's around price and he's making, he's upping his bid. That's an aggressive buyer, right? See, this is this curl. The reason why it's tricky is you got all these blues. So you got to get like through these and then you got your best chance to go down. Here's another thing that's really important about putting on positions. Knowing where the hell you're going to get out before you get in. So if you take a shot and let's say you sold it here off this pink triangle, that's fine. What you don't want to see another blue come in, maybe you can get out. You don't want to see it get above this pink, maybe you get out. Maybe you take a small winner, scratcher, small loser, but now you're fighting for your position and it's not arbitrary as to why you get out. But you're reading order flow instead of staring and trying to analyze numbers on a screen. All right, what did I say about the chaser? Aggressive buyers and aggressive sellers. If someone is up in their bid, they're aggressive, correct? What if someone is up in their offer? Instead of offering 92, to, you know what, I'll offer 94s. They're passive. So we're tracking that because Dave's written it to always track bids and offers through order ID and the changes they're made. I said, Dave, let's just tag the people that are upping their bid and upping their offers, because upping their bid, they're aggressive buyers, upping their offers, they're passive sellers. So if they're white, they're aggressive buyers below. If it's white above, they're passive sellers. All necessary for the price of anything to go up. That's why this could have disqualified trying to sell resistance up here, because it stayed white. Green gray is a better combination for price to go down. Why? Because there's more longs and there's more aggressive sellers. It never went green gray in this whole sequence. It stayed red white. So white means, again, aggressive buyers below and passive sellers above. Gray is the opposite. More aggressive sellers that are lowering their offers and buyers are lowering their bids. So when you see it gray below where price, and this is, by the way, where price is, the center. So if you see gray below price, those are bids that are lowering their bid. They're passive. If you see gray above, they're expanding and they're lowering their offers, which means they're aggressive sellers. Aggressive sellers and passive buyers, that's similar to more sellers and less buyers. This is the opportunity where you see a bunch of shorts puke in that green profile. You got three now sell imbalances to play above. You're at your green resistance. You take a shot, and who cares if you're wrong? Because now you know where the hell to get out. You're all trying to get head starts. Now, if you can get green, and it already did, go gray, you got your best chance to go lower. This doesn't mean it's going to go lower. It's just a probability. Don't let anybody make a call without being able to explain why and where you're wrong, or it really doesn't matter, because in real time is the number one weakness of every trader. And if you're not continuing to work on a tool that allows you to be objective in a very subjective game, you're in trouble. One thing, most of you guys are from Dr. S, right? Dr. Steenbarger. He said this a million times. He goes, you constantly are working on an edge, a new edge, the same edge, an advantage, because you're not going to be consistent unless you have some semblance of an advantage over those you trade against. See how it went? Now, this is another reason to, like, if you got short up here, to say, I'm earlier, I don't think it's going to work, because it went from green, gray back to red, and you're out here instead of out up there. Maybe you get back in when you see a pink triangle. Maybe you're not out because it didn't get above the green. The point is you're reading what's important instead of how you feel. Trade what you see, not what you think. The problem is most people don't have good tools to see. But once you do, trade what you see, not what you think. You know how Dr. Steenbarger's obviously talks a lot about psychology? He would agree with this. Trading psychology is not going to make you money in trading if you don't know what you're doing. All right? Trading psychology will certainly help, but you have to know what you're doing first. You have to understand everything we talked about in this webinar, and the concepts of longs are now sellers and shorts are now buyers and so on. But if you skip over that and you're like, well, the psychology and being able to marry the mind and the markets, that's what I'm missing. No, that's not going to give you the skill set. You have to know what you're doing. You have to put yourself in a position to not feel like it's random or a good guess when you're right, and walk yourself through what you need to see in order to predict the dynamic that needs to exist for the damn price to go down. And who gives a shit about your bias? Care more about your location. A lot of people put too much emphasis on their opinion, and then when they're wrong, well, number one, you struggle with admitting you're wrong. We all do. So detach yourself from your opinion. It's just one trade of tens of thousands of trades that you want to take throughout a career. Why would anyone be important? It's not. Like, I care less if this market, like I said, has the best chance of rolling down. Could care less if it does or not with people watching. I walk you through why it should go down. At the very least, it stopped going up. It went green, it went gray, and it's staying below these pink triangles. Now you're seeing why it should go down. Like, it really has a good chance to go down like it is now because it's breaching these three blues. Again, those watching live know that this is the live market. Whatever, 11:43 here on the 14th of November. And I have to say that because a lot of things I said happened exactly as I said it. And so there'll be some smart ass in the future saying, oh, this is a recorded video. Either way, going back to Dr. Steenberger, when you think psychology is what you've been missing, but you really don't know what you're doing, then it's not. It's not what you're missing. Again, it could fill in some blanks. But do you want a surgeon when you're flatlining on the table to stop and do breathing exercises so he could psychologically calm down? Or do you want the son of a gun know what he's doing? So psychology is important, but it ain't first. And oh, by the way, you'll do yourself a whole bunch of good if you strip out randomness and you're more objective. Your psychology will fall right into line when you're like, hey, if you did get short up here looking to use the green as resistance, guess what? First blue you see, maybe you get out and it goes green to red because red and white is bullish. And the first buy imbalance you've seen in this little break would get you out. Then you get out. Now your psychology falls in line because you're not trying to be like, well, I feel like it's going to roll back. Forget about how you feel. Trade what you see, not what you think. So these are exits for people who take a shot getting short up here. If they see any blue triangles, they'll exit. If they see it go green to red, that's bearish to bullish. Now, I don't expect everybody here for the first time to understand that green gray is bearish, red white is bullish, right? PWAPs are resistance. The red one we get through, it's going to go to the green, and it does. And the pink and triangles are sell imbalances. Now there's a few of them, and as soon as they go from red to green like they do, and you get this one, and you breach this, it has a good chance of going, and it does right in here, and so on and so forth. And you could see it rotate with imbalances. Nobody would dispute that it takes imbalances to move price. More sellers and less buyers. I know this without anybody saying it, that this is a very unique way to explain these concepts because 99, not 9 out of 10, 99 out of 100 people who come to me, and I always talk to people who sign up for the room, which shows these charts. And again, I'll answer some questions in a second. But I always have a phone call with everyone that's ever signed up because it's worth 20 minutes of my time to find out a little bit about what someone's expectations are, see if this is what they're missing, and point them in the right direction, because there's a lot of videos that take what I'm talking about in depth. Plus, you come to this room every day and see these charts in real time and make heads or tails for yourself. At this point, they're not downloadable. There's no dome to it. It's just an add-on. Your first step is what I'm going to talk about at the end. Take a shot and join for a month and go from there. But before I get into that, what's important to realize is that you're seeing something unique. Nobody else has this. The next couple features I talk about, those two things are these next two things are going to be on most platforms. And I don't think there's examples of it now. There might be. Dave, you want to put up icebergs? So any iceberg orders, a couple of them, green lines are buy icebergs, red lines are sell icebergs. And if you don't know what an iceberg is, if someone's showing a 10 lot and he gets filled 10 and he's still there, guess what? He's an iceberg. So we show how many he's showing, how much he has done, and any kind of movement of lowering it or raising it, and then how many he finished with. So icebergs. And then the last feature are big market orders, 100 or greater. You want to pop those in? So if it's a light blue box, just like the light blue triangle, you see one right here, it's a buy market order of more than 100. If it's a pink box, just like the pink triangles, it's a sell market order of 100 or more. Now, here's the difference. Pink triangle are people who want to sell it, and there's many more of them that want to buy it. The pink box is an actual order that gets filled. And I'll quickly talk about how to use it. Is if you get a 200 lot sell market order, where should price go? Down, right? Now the question is, does it? Say, look at this right here. Right here is if you're bearish and you want to get short, you see a pink triangle and you see a big buy market order and the effing price rejects it. There's a probability it's going to do that. Because think about it. If I punch a guy in the face, he should fall over. So big market order, buy market order comes in, price should go up. But what if I punch the guy in the face and he doesn't even flinch? He don't even move back. I don't know about you, but I'm running the other way. And that's what price did. It rejects a big market order. That's the way you better start using big market orders. Don't go in the same direction always as them. That's conventional wisdom. Conventional wisdom is more buyers that buy it. No, they're done. Big buy market order already is done. You're wasting some good buying, right? So when he gets breached, it's cause of a bottom, right? And then you got same situation here, decelerating triangles. You got to reject it. This is kind of be a moment if you're short from above. I'd get out in here only because you rejected this pink. There is more downside. Now here, back to bearish. First pink triangle will go up like that example that we had 20 minutes ago. We hadn't had any pink triangles. But this is like the flip. I still think like when you get a pink triangle and they puke a lot of longs, if you want to kind of protect your short position, take a shot to get out. If you didn't and it breached this blue and came down and showed another blue, you exit there so you don't have to feel this pressure. Who cares if it keeps going down? The reason is that these pink sell triangles are probably done. The sell imbalances, they're probably done. And this one really kicked us up. So now you're out at the worst there from your short position instead of riding this son of a bitch up there and saying, oh, should have got out. Read real time. Rejection of a sell market order. Again, punch a guy in the face, he should go back. The sell market order punched the price in the face and it didn't flinch, didn't go down. It quickly came up against it. And when you see that, that's how you start reading orders that get filled. Because you're wasting good selling if you're still short. If you're short and you see a big sell order come in, it's like, okay, but now he's done. I'd rather the pink triangle because those are guys who are still like having to sell it. They haven't yet. Another thing is they flickered and they went red. You can see where they went red, white, probably up in here. And then that created the upside. And that, again, they're going to use the red and the green as overhead resistance like it used the green earlier. So does everybody understand the difference between if I would have started this webinar showing you all of this? Human nature is everybody be overwhelmed. Hell, why wouldn't you be? But when I walked you through each feature, it's not overwhelming, is it? Everything has a purpose. It's not one of these charts that got all kinds of SHIT all over it and can't make heads or tails. Everything has a purpose and it falls into the very concepts that move price. Nobody would dispute everything I said with respect to why price moves and that shorts are buyers and longs are sellers. Nobody disputes that. Nobody can dispute that. Now it's up to you to see it for yourself. I helped have people understand it. I came up through the floor through a real prop firm. So there's no other charts that do this. They can't. They'd have to have, and even if you had access to MBO data, it's just raw data that has to be filtered a certain way. But nobody, except the icebergs and the big buy and sell market orders, nobody else has really these buy and sell triangles because there's also a uniqueness to when price starts to walk away from it and there's a imbalance left behind. It's not just the numbers and the orders coming in. These are actual order types. The chaser actually walking up, walking down, and comparing the two. Certainly the OPP, tagging longs and shorts in the market, showing the average where it is on the chart. Like I said at the very beginning, you don't have to take my word for it. What we talked about, you've seen happen on this particular day. And those here live know that this is where the S&P minis are in real time, this is a live chart. Now, I'm going to keep the recording going in case there's some answers I have that are relevant. A lot of times people don't care as much about somebody else's question, even though I think all questions are important. But I'll keep the recording going. But this is the end of kind of like the presentation. Other than go to the website, edgetrading.com, and sign up for a month and see these charts for a few hours in the morning and my commentary over them, like we kind of did today, but throughout the morning session. Plus, there's videos and all the other content to help understand markets deeper into just not only these features, but everything else that drives price up and down. What was the other thing I wanted to say with oh, YouTube. Search Edge Trading Group on YouTube and watch the short videos I show of highlights that we do from the room. Now, to the questions that we have. Let me go up to the top. There's Silent Check, Dr. S. Oh, here's how people, what people are trading: stocks, options, wanting to get into futures, maybe something with ES or Dow. Because I asked a question earlier, what do you trade and how long? All equities many years ago, the ES for 3 years, stocks for many years, live trading for 6 months, but years of training. Here, I'm going to tell this guy that said, I don't, it's a tough spot. You don't know what you don't know. And almost everybody, the regret when they find me is they wish they'd have found me much earlier. Your first, second, third investment in trading is generally not going to be worth it. And it's not your fault. You don't know what you don't know. I came up in the damn CME, got it. And the first couple damn classes I took sponsored by the CME sucked. So even me taking education from the CME, they were just, it wasn't the CME's fault. The teacher wasn't really good. And so even though I was in the venue of professional traders, the teacher was talking about nonsense spread trading. It sucked. But then I did get a class that finally was worth it, and it wasn't cheap. It cost $1,700 for all 3 levels in not today's money, but it was $1,700 back then. But it was worth it because it was a live kind of pit trading, which it helped you understand order flow and other stuff like that. And by the way, like when you're using resistance, you want to be able to disqualify as much as you want to qualify. If you don't get any qualification to get short, you save yourself from resistance not working. It stayed red, white this whole sequence. Really, no blues have been breached. So why get short at the red or the green? Saving money is like making money. All right. So then we go back to the questions here. Let me roll up on them. Someone says, likes the concept, makes sense. Going back to the education, though, remember this, though. Whether you've had bad experiences with previous other educators or not, you better hope someone's teaching the right stuff, or how are you going to learn? Someone's talking about it making sense, interested in the data and tool help predictability. Like I said, edgetradinggroup.com, Jeff. Not yet. Can user adjust the number of imbalances? It's not downloadable enough, but at some point it will be. There is no timetable for it. And if people wait for that, they'll be waiting a long time, potentially. Chris had to leave, but he'll look for the recording. You have to do that yourself, Jeff. Back test and everything else. I know people like to see everything be scientific, but it isn't always that way. There's different ways to use qualify. It's not a system essentially that is being offered here. And I think some of the other questions I answered with respect to saying what the probability was breaking, selling out of that breakout, what was needed to bounce. It's not an add-on script to Ninja. So the question is, does it add on to Ninja? No. Jeff, send me an email with that question. I could explain better with as far as the subscription and what it has. We go to the website. It'll help answer that question. And it's not as, I'm going to probably put a PDF out to make it easier. It's not as difficult to sort out the colors and everything because it's what's the word? It's like pretty practical. Red for a short, green for a long, pink for sellers, blue for buyers. It's pretty consistent. But I think there should be a little PDF to make it easy to have it be reactionary. Because the other option is to try to read and pull this information, glean this information from a dome or a footprint. Good luck. People want to read order flow. You obviously want to know what's important and what you're trying to read and pick up on. Again, it's not an install for Ninja or outside of Ninja. It's not an add-on script. It's just done through a screen share for now. Yeah, I was planning on doing that. Good idea. Dave, you want to answer Jeff's last question there in the chat if you pull it up?
Let's see.
Do it in the chat though.
Okay.
Yeah. I'm gonna pull in the let's see it down here. Hey Kevin, hold on a second. So here's the way to join the room. The room is the best place to start. And then I'll walk people through what's required to have access to this all day. But you're gonna have access to it for a while. Plus, when people join, I set up a call and I explain how to have access to this all day. So we're keeping this more unique to the serious traders and not, you know, the 22-year-old kid who wants to buy Bitcoin and make $1 million next week. Like I said, this is a very unique tool, not on any other platform. And you guys could see the value of it. I'm going up through some other questions. Roland, I just put that in there for you. You should have it. And anybody else, the link to check out. Also, the link to pop in around the website. Here's what's important. If you have the opportunity to ask yourself, what are you missing? Is it location? Is it timing? And I bet it's all those things. Even if you're consistent, location is always everyone's weakness. How do you get more objective? So if you thought that this webinar made sense to you, you go to the website and you look at some of the stuff that's on there. Join for a month. It's like a trade. From that, I schedule a 20-minute phone call to make sure there's certain videos I make. You don't have to watch. I don't want you watching every damn video on the site. Certain videos that I'll steer you to as I get to know someone in 15, 20 minutes. Because it's important to give people the best chance to do this. And right now, access to these tools are screen share only.